Good morning, everyone. I'm Mick O'Brien. I'm the Managing Director of EQT Holdings, and welcome to this seminar this morning to talk about the listed market and managed investment schemes being listed as ETFs or listed investment trusts, and also the LIC market. So we've got a panel today of very experienced, esteemed speakers who can talk to you with great expertise about this space. So firstly, I'll welcome Rick Steele. He's the CEO of Loftus Peak, and he's going to talk to you about first-hand experience of listing a scheme on the ASX. I've also got with us Bill Fuggle. He's a partner at Baker & McKenzie, has done an enormous amount of work in this space and for us here at Equity Trustees, which we're very appreciative of. And I've also got Russell Beasley with us, and Russell is our Executive General Manager of Corporate Trustee Services, and he's been heavily involved in listing various vehicles over the course of the last 3 years. So I'm going to start with a short presentation that just takes you through the listed market, and a little bit of it is 101, some of it might go up to 102, and I think it'll give a good overview of what we want to talk about, and then I'll introduce the panel to talk to them. So first thing, funds managers are really looking much more closely at the listed market than they've ever done before, and there's been some real explosion of activity in recent times. And you'll see this slide here just takes you through the dimensions of the market as it stands at the 31st of October. So the market cap of exchange traded products is 125 billion, and that's considerably in excess of the LIC and the LIT, or listed investment trust market, at 56 billion. And you can see more than double the number of issues in exchange traded products than what we have in LICs and LITs. So 229 issues out there, 101 LICs and LITs. Perhaps the next two pieces of data are the most important. In the course of the last 12 months to 31st of October, the market cap of exchange traded products has increased by 69%, and of LICs and LITs by 16%. And the number of issues has increased by 5% on exchange traded products, and it's decreased by 8% for LICs and LITs, as we've seen some of them exit the market. So just move on and look at where some of those funds are invested. On the left-hand side here, you can see the asset classes. So it's a broad mix of asset classes, but the number one asset class for exchange traded products is global equities. And to some extent, a lot of that would be in the indexed or passive space. But you can see all asset classes are involved. Australian equities is building there at 26%. And I think there's a lot of interest in the fixed income side, and that I think we would expect to grow over time. Now, I guess when you think of the exchange traded market, you tend to think of it as being an indexed market, a passive market, and primarily it built up that way. But of late, in the last couple of years, we've seen the influx of active strategies, and I guess some strategies are a little bit hard to define as to whether they're active or passive. They might be better described as sort of smart beta strategies, but this slide is showing those that are truly active versus those that are actually passive. And so the exchange traded market shouldn't be thought about as being, if you like, an index market alone. In this particular area, people often get confused between a listed investment company, a listed investment trust, and an exchange traded fund, and what the differences are. And this table just tries to highlight some of the key differences. And I guess I'll start on the first point. There is a potential in a listed investment company or a listed investment trust for the stock to trade at a discount or a premium to the net tangible assets of the fund. That's certainly the situation in LICs and LITs, but it's not the situation in exchange traded funds where market makers are in place. A flow through of distributable income, taxable distributable income, that's not the situation in LICs, but it is the situation for listed investment trusts and exchange traded funds. Discretionary dividend policy, that does apply in a listed investment company, that the board has that discretion of capital management and the dividends that are distributed, but it's not the situation for an LIT or an ETF. Governance in a listed investment company, you have a company board of directors managing that company. For listed investment trusts and exchange traded funds, responsible entity is required to manage them. Fixed and variable capital for an LIC and LIT, effectively they have fixed capital unless you go through a capital raising, whereas for an exchange traded fund it is variable capital, so it's an open-ended scheme with capital being created and redeemed over time. A market maker and an INAV provider are required when you have an exchange traded fund, but not in the situation for an LIC or an LIT. And the last row, isn't definitive, but broadly the LIC market has been an active funds management market, and the LIT market has also been an active market of managers that are active managers. And the exchange traded fund market, as I showed before, has primarily been passive, but over time has been building to be active. Now, developments have been happening in the exchange traded fund market. So mentioned before, that there's a combination of active and passive exchange traded funds. But more recent developments have seen smart beta strategies developing, as well as completely active strategies developing in that space. On the right-hand side, what we've seen in the last, 18 months or so is the development of what we call quoted funds. So quoted funds, the traditional open-ended variable capital managed investment scheme that most fund managers have put to the market over recent decades, have been evolving to allow managers to introduce a second sleeve, being a listed active ETF in an existing unquoted open-ended managed investment scheme. And so that's what we call a quoted fund. So, what is a quoted fund? Well, it is a registered managed investment scheme. It's quoted on a securities exchange. It could be the ASX or it could be Chi-X Australia. Unlike regular exchange traded funds, quoted funds utilise a single registry system, allowing investors to invest either via their broker or directly with the registry provider. And the fund must comply with the exchange's operating rules. You do require other service providers that, other than your normal custodian and transfer agency provider or auditors, but so you also need an INAV calculation agent to be able to publish a regular INAV, and a market maker, be that an internal or external market maker. So the last point, you cannot have a fund on an M fund service be quoted as well. So just that's worth noting. How does a quoted fund work? Now, I'm not going to go through this slide in detail, but effectively what you have is investors that can come into the scheme either through their broker and through CHESS and be transacting on the market in a price discovery way, or they can come into the scheme in the same way they have been coming into the scheme, effectively in the unquoted sleeve of the scheme, and doing the normal registry and normal applications and redemptions in the way that would normally work. The important thing to note about this for the fund manager, there is a single asset pool. So it's not like there are two distinctive asset pools. All investors are feeding ultimately into the single asset pool. I'll move on, and just this table just describes the key differences between the listed sleeve of the fund and the unlisted sleeve. So the potential for a discount or premium to NTA doesn't exist in either side of the scheme. The flow through of distributable income is the same as it is in the unlisted sleeve. It's a complete flow through of distributable income. Pricing on the listed sleeve, pricing is effectively through price discovery on the market, and it's immediate pricing. So the investor knows the price they are transacting at when they put their orders in. The unlisted sleeve, it's the same as what the current situation is today, that end of day based pricing based on the NAV of the scheme is used. Settlement in the listed side is normal ASX terms or Chi-X terms in terms of settlement of T+2. On the unlisted slide, it's the scheme's terms as they would normally apply, and generally they'd be of similar order. Governance, the responsible entity is in governing both sides of this single scheme. The capital is variable on both sides, so it is open-ended capital on both sides. And the market maker and and the INAV provider are being utilised on the listed side of the scheme, but not utilised on the unlisted side of the scheme. And this just talks about the ways of transacting. Investors can transact in the fund either way, and it's fungible between the two sleeves. So the normal way of using an application form and providing KYC documents to the registry and sending dollars, or withdrawal instructions to the registry, and the NAV is applied, at the end of the day, and a shareholder reference number issued. It's time-consuming and paperwork intensive. However, trading through an exchange via CHESS, you come with a holder identification number. The broker is responsible for your KYC. So once settled once with the broker, applies to all of your investments from that point on, T+2 settlement, and CHESS feeds into the registry system and straight through processing. And the investors with the SRN can be converted to HIN investors and vice versa. So it's fungible between the two sleeves. I won't go through this slide in a lot of detail. There's a lot there, but what is a market maker? What is an INAV in respect of these schemes? So a market maker ensures there's buyers and sellers of the exchange traded product can transact as close to net asset value as possible through the course of a day. They provide liquidity to the market by providing quotes for bids and offers throughout the trading day, frequently updating their quotes to reflect changes in the INAV of the fund. The objectives of the market making activities ensure investors can transact at a price as close to NAV as possible at the time of the transaction. Treat all unit holders fairly, so the buyers, the sellers, those that are existing in the scheme and those that are potentially considering it, with respect to price and liquidity at all hours through the exchange's opening hours, and minimise the impact on the fund of that market making activity, and provide information barriers that need to be established from time to time. On the right-hand side, what's an INAV provider? So an INAV is an indicative net asset value. So the INAV is calculated by a specialist INAV provider, such as ICE or Solactive. The administrator provides the fund's portfolio composition to the INAV provider. The INAV provider consumes the data into their system, looks for current and available proxy prices on a security, but real-time value. And that INAV is calculated on a frequent basis throughout the course of the day and published. So investors can see it. If a fund manager is establishing a fund and wanting to create a listed sleeve, so creating a quoted fund, then it's a fairly time-consuming process to get started, but once started, very automated in terms of how the scheme would operate. But often you'll need to revise the constitution, the compliance plan, to ensure they meet the operating rules of the exchange. You lodge that with ASIC. Service provider agreements need to be negotiated with the INAV and market maker, as well as changes for the custodian and the registry provider, with service level agreements and deliverables finalised, and the whole end-to-end process mapped out. PDS offer documents need to be reviewed to enable investors to understand they can come into the scheme in the two different ways. That needs to be lodged with ASIC and provide the 7-day exposure period, and units can't be issued until that's expired. Submission needs to be made to the exchange, be it the ASX or the Chi-X exchange, with all the details of the scheme that's going to be listed. The fund may undergo an ASIC review subject to the complexity of the fund and its assets. And then you need to be operationally ready to update to the website INAV feeds, additional disclosure and reporting, and participate in the reporting cycle for a quoted scheme. There's a range of new documents that are needed when a scheme is listed, so updates to the conflicts of interest policy, information barriers policy, internal market making policy, permitted discretions policy, unit creations and cancellation procedures change, INAV procedures, market making procedures, and bespoke fund compliance plan outlining the exchange's operating, the scheme's operating obligations in respect of what the exchange requires. So hopefully that gives you a good overview of listed vehicles and as they apply in this space, and particularly what we're talking about here is quoted vehicles. But now I'd like to introduce our speakers and go through a Q&A session to talk about this. So I introduced before Rick Steele, CEO of Loftus Peak, Bill Fuggle, a partner of Baker and McKenzie's, specialising in this area particularly, and Russell Beasley, our Executive General Manager of Corporate Trustees Services. So I'll just stop sharing my screen now for a second, and hopefully we've got everyone coming on board. So just give them a second. Right. Well, good morning, everyone. So with that introduction, I'm going to throw the first question to you, Rick, and I'm just going to ask, you've recently gone through the process of listing a scheme. Why did you go down this path, and what was your thought process in doing that?
Well, when you say recently, Mick, this started a long time ago. I mean, I have been involved in listed vehicles over the years, and LICs in particular, and noted some pretty important flaws in that product. So I was always on the lookout for a solution like this, and when it became clear that this was possible, I moved quickly to make sure that we're part of it. The major reason for doing it for a fund manager, for a boutique fund manager in particular, is to ensure that your capability can be put in front of all of the market segments that you would expect to be able to market to. We were one of the earlier entries into M funds, and that was useful. But M funds too had its own flaws, which I won't go into here. But what we did was decided it was important to take our presently unlisted managed investment scheme and to make it listed. So we're that particular migration. And in the process, effectively deliver M Funds 2.0, right? Because it was a listed vehicle, more palatable, I think, to a broader marketplace. One of the drivers, interestingly, were prospects saying, I like what you do. I don't like it that I can only buy it on a wrap or directly. Show me something else. Show me something listed. And so that was always bubbling away in the background.
Thanks, Rick. So, so what was the experience like, dealing with the ASX and the different service providers and the onboarding process with Equity Trustees?
Well, we were a first mover, trailblazer, and that brings with it, on the one hand, some advantages, but on the other, some disadvantages. It was the best part of the year's effort from go to woe. But what I would say is, and it felt to me as if we had the A team and each of the service providers that we're dealing with working on this matter, right? We had best legal counsel. We had, I thought we had most of the key people in EQT batting up to our weekly meetings over 9 months to make this happen. And within Mainstream, who was our registry provider, we were heavily supported. So I think without all of that, it couldn't happen, right? We would not be in a position to do it on our own. But I think our experience was very positive. You mentioned the regulators, and I'd regard our ASX having a regulatory component in this. They were supportive, but what we had to do had to fly, right? It had to make sense. We were introducing this fund at about the same time that Magellan was bringing Airlie to the market. Airlie being an Australian underlying securities version of an active ETF, and it took us a further 6 months. So they launched in May of 2020. We didn't launch until November 2020, and I would put that down to the fact that our underlying securities were global securities, and that created some uncertainty about the validity and the ability to track and estimate the INAV through the course of an Australian ASX trading day. And to provide the appropriate assurances both to the ASX and to ASIC was not trivial.
Yeah, no, that's quite right, Rick. So Rick, what have the results been so far? Have the volumes and the capital raisings met your expectations, and how does it compare to the two sides of the scheme between applications coming in the listed side versus your traditional way?
Yeah, well, what I would say first of all is it's a big risk, right? Because the market segments are, on the face of it at least, are quite different. It may be that a product that appeals well to a managed investment scheme marketplace doesn't apply as well to a listed environment. There might be different features that are more marketable. So there was a risk in doing it. Our experience, I have to say, has been positive. On the very first day, and it wasn't decided until a few days prior, we converted all of our M fund holders to active ETF holders over a weekend. So they were the core initial group. And then over the period of that 1 year, I think we've added 1,000 or so unit holders. And that business now represents about 20% of our company. So it's been a material, successful initiative, but not one without risk.
No, thanks, Rick. It has been an enormous effort, and it looks like, in the early days, it's been worth it, and should continue to be. So as you say, this structure solves a lot of problems for a lot of investors. So let me now turn to Bill. So Bill, you've had enormous experience in listing vehicles. Can you talk to us about the difference between the two exchanges, so the ASX and Chi-X, and why you would go with one exchange over the other?
Yep, sure. Look, first of all, I'd say they're both solid venues. Probably Chi-X is a bit more nimble in the sense that they probably have a bit of a flatter management structure. So the people that you're dealing with at Chi-X are generally going to be, only one step removed really from the top, or at most 2 steps removed from the top of the chain. And so you can get a stronger and deeper buy-in to whatever you're doing at Chi-X. ASX, by contrast, has got more layers, as you would expect, I guess, with a larger exchange, particularly in relation to their risk management side of the equation. So if you're doing something a bit unusual, you might be a bit quicker down at Chi-X than at ASX, just because of that difference in management structure. Obviously, ASX is more well known to investors, so you've got that material positive. But having said that, both Chi-X and ASX operate through CHESS, so it's from a touch and feel perspective, you're still going to have the same kind of use of your normal CHESS, or if you're a retail investor, you're going to be able to use your ComSec account or whatever it is you've got to use to trade. The other thing is the rules are slightly different, not super materially different, but and indeed they've kind of narrowed those differences. There used to be a more material difference in the definition of what acceptable underlyings were, where actually Chi-X was a bit broader, but ASX has amended its rules to pretty much now track those Chi-X rules. So that difference has kind of largely disappeared now.
Thanks, Bill. So, if you're transitioning a fund from one type to another, how does that play out contractually?
Look, that's always like the $64 question. Clients come to us at Baker McKenzie pretty regularly, and the proposition is that either they've got an existing fund or they want to start up a brand new fund, and most of the time they've got an existing fund. And so it used to be, the question was, well, okay, should we try and list this existing fund? Should we do a feeder fund into it, which is what, for example, Platinum did? Should we create a sister or twin fund and quote it, which is what the original Magellan ETFs, actively managed ETFs, were? And then, sort of what's the trade-off between these various options, sort of the whole shebang, a feeder fund or a sister fund. And it's an interesting trade-off. But then, sort of gradually, I guess a number of us collectively developed the idea of having this quoted, unquoted single class, which meant that you also had the option of doing what Rick down at Loftus Peak has done, which is you've got the one fund which has got both a single class, which includes both quoted and unquoted units. So now you've got this fourth option. And there's all sorts of pros and cons as to which of those four options you would choose. But some things which are common to all of them are around, do you need shareholder approval to change your constitution? Because obviously if you do need shareholder approval, that's going to add sort of a number of weeks, because you're going to have a notice of meeting and the notice period. And also, what changes do you need to make to the PDS? So those are usually the two big questions. We're of the view that typically you don't need to have a unit holders meeting to change the constitution, because it's not adverse to holders on our analysis. And the PDS changes are relatively benign. Having said that, there's a number of other things you need to do, as you and Rick have already mentioned in your presentations, around, particularly around arranging market making, Chinese walls between those who have information about the underlying portfolio and those who are who are interacting with the market maker, INAV, things like that. And I mean, having said that, I think Rick, as the trailblazer, obviously his process took longer. I feel like we're getting them through a lot quicker and easier now, as is typically the case. So I wouldn't be sort of thinking it's going to take 9 or 12 months. It's probably something that you should allow, I guess, 3 to 6 months for, probably more than towards 6 months, once you factor in that you've got to get these market makers sorted and these other service providers. But if you allow yourself about 6 months, that should be pretty safe, I reckon.
Thanks, Bill. Another one I'll throw at you as well, Bill, is, we had a sort of a rush of listed investment trusts, probably sort of 2 years or so ago, and now more exchange traded funds. Can you talk about the advantages and disadvantages of the LIT structure versus the exchange traded fund structure? Yeah,
look, they're actually both good structures for certain situations. So the LITs, you still get, there's still a lot of LITs going through, although not the same type. There's a lot of LITs going through in the which are REITs, real estate investment trusts at the moment. So you've had the HomeCo series, you've had Eleanor, we've had Real Asset Management, or REP. And there's a couple more coming through the pipeline. So there's a lot of LITs still going through, particularly in this real estate area. And they are really typically targeting people who might traditionally have put their money in the bank, is kind of what people are in a situation where they are, or that you're really trying to give people sort of a decent return with a relatively low risk, sort of better than 0% return on bank deposits sort of thing. So those are still being quite popular, but there is no market making in those LITs. And the ones which came on a couple of years ago, when there was a bit of a rush of other ones, were mainly fixed income style LITs. And the reason they were going onto the main board was because the underlyings by and large didn't qualify at the time for to be ETFs. Particularly from an ASX listing rule perspective. But so the big difference is that the LITs, that you can't have market making, and so you don't have the INAV, and there's a bigger risk of deviation from NAV, although you can do redemptions, so that helps squish the deviation from NAV. But you would be able to be a LIT with a broader range of underlyings. In other words, you don't have to have the sort of deeply liquid tradable underlyings that you have to have for ETFs. So for ETFs, you can have market making and all the bells and whistles and the perfect correlation with NAV or near perfect correlation with NAV. But you do have to stay within a set of boundaries as to what the permitted underlyings are. And in particular, for example, you can't have more than 10% OTC derivatives unless it's for interest rate or FX hedging. You have to, and the underlyings have to be in some way, shape or form, have strong price discovery associated with them. So they either have to be traded on an exchange or they have to be traded on some deep liquid market. So either stock exchanges or, for example, gold has obviously got a very deep non-exchange global market. So the bottom line is that there's a smaller universe of what you're allowed to put onto ETFs, but once you put them on there, that's probably state of the art in terms of tracking with NAV. Versus the LITs, you've got a broader range of underlyings, and it won't deviate from NAV too much if you still allow redemptions, but you're not going to have any market making.
Got it. Thank you. Thanks, Bill. It's the devil is in the detail when you go through that, isn't it? So, yeah. Russ, here's a question for you. It's not exactly a cheap process to create a quoted fund, and cost can be a bit of a barrier to entry. What's the extent and nature of the costs that managers and funds can expect?
That's true, Mick. And the costs come in two parts. Firstly, there is the setup cost, and there's a lot of heavy lifting done on the part of the legal advisor, we've used Bill extensively in this particular process. There's, as he mentioned, there's changes to the constitution required and the compliance plan, but more importantly, there's a fairly extensive process that goes around the due diligence of the offer document, which in these cases are a long form document, and the legal firms typically run the due diligence process and the verification of all the details disclosed in that particular document. And then it's there is an approval process by the EQT board, in our case, following that due diligence exercise. There's also a larger setup fee than what we would normally charge for our services in project managing the setup of these particular funds. There's a lot of heavy lifting involved on our part, a lot of liaison and with both the fund manager and the service providers. And there are listing fees for both the ASX and Chi-X. So they're the setup fees. There's the ongoing fees. And of course, you've got the introduction of the two new service providers, being the market maker. And the market maker's costs can range in the order of $10,000 to $15,000 per month, plus 5 to 8 basis points on any trading. You have the INAV operator in the instance we have. That particular costs in the order of about $4,000 US per annum. And then you've got the ongoing ASX and Chi-X fees as well. So, you need to be very certain that you've got a decent FUM to be able to absorb some of these fees.
Thanks, Russ. And so, are these costs coming down, or how do they compare to what you might see overseas?
It's a good question, Mick. We've had feedback from our offshore manager clients that the fees, particularly for the market maker, are very high compared to what they're used to paying. And I think we're seeing the introduction of more providers in this space. I think what will happen is I think market forces will see these prices reduce over time.
Yeah, got it. All right, thank you. Initially, in terms of providers of custodianship and registry in this area, it was Mainstream, or now Apex Fund Services. What's the situation with choice now? Especially if funds are using other providers in this area.
Yeah, as you say, Mainstream was the pioneer in this regard, but I think others quickly saw how this might take off and responded quite quickly. And we now see that Link, Iris, or formerly OneView, and Boardroom, and indeed others, can now provide this dual listed and unlisted registry service.
Got it. Thank you. All right. So one of the key differences between these schemes is the nature of either the closed-end structure of the scheme or the open-ended variable capital structure of the scheme. Perhaps I'll put this first to you, Russ, and then to you as well, Rick. What should be top of mind in thinking when you have those two different arrangements? Perhaps, Russ, you could start with your thoughts.
Mick, I think from the closed-end vehicle, I think the main issue there, or one of the main issues, is that you don't have to worry about liquidity management. You can basically manage your strategy without having to, allow for redemption and/or application flows. But on the negative side, I think for a closed-end vehicle, as you pointed out earlier, the funds can trade at either a discount or a premium to NAV. And particularly if they're trading at a discount, you can attract unwanted investor attention. And indeed, you have, activist investors that watch this space very carefully, particularly in the LIC space, where you may attract some unwanted attention in relation to that, particularly if you're trading at a substantial discount to NAV on a regular basis.
Rick, what would you add to that, and when you're thinking about that? You're just on mute, Rick.
I'm a fan of the open-ended vehicle, right? I just love the honesty of it, and it does mean that you have to continue to deliver to your clients in order to retain their confidence. And for clients, it means that they can increase and reduce their position easily and at will, and that actually is an attraction in the medium term, and might bring additional clients to your fund than otherwise would be the case.
Yeah. So, I think I guess this vehicle structure sees all the advantage for the client in the immediate liquidity and variable capital, and not having to ever have to deal with a discount. I guess from time to time there are managers who have got investment strategies where they don't want calls on capital at all because of the nature of the asset class, but they're fairly narrow, would be my sort of take as to maybe a structure that is closed in for those is the right way to go. So I think we'll probably still see some of them, but I think your point's well made, Rick, about allowing investors to transact as they want without having to wear that type of discount if it is prevailing. Well, that sort of leads me, I guess, into the LIC structure. So perhaps, Russ, this is one for you. So if a manager had an LIC structure, right, and was wanting to change to an active exchange traded fund, or even, unlikely change to an unquoted managed investment scheme, that's probably unlikely if they've secured all their clients through a listed vehicle. Some funds have made that transition of late. What's your observations about how you go about that, and what's happened to their client bases as they've done that?
Mick, we've actually transferred an LIC to an unlisted structure. We've not transferred an LIC to an ETF at this particular point, but I know of one experience where that has been the case, and I believe that as a result of that, there wasn't any substantial loss of clients as a result of that particular initiative. In our experience, transferring from the LIC to the unlisted vehicle, clearly you need to get unit holder approval to do so. There's also a change of the constitution required. And there is, a certain amount of reliance on legal assistance to lead us through the delisting process. It's there's a fair bit of work associated with that. In the instance that we had there, again, there wasn't a substantial loss of clients in that process. The manager concerned was running a listed strategy or an LIC and an unlisted strategy that were very, very similar in nature. The performance of the particular vehicles was good, which certainly helped in this particular case. One of the challenges we did have, though, was the fact that because the AML and KYC had been done by brokers previously, when it transitioned across to the unit register for the unlisted side of things, we had to go through an exercise of getting signatures and going through the AML and KYC process, which was a a fairly extensive piece of work that we had to do, and prevented some investors initially from going out or from redeeming quicker than what they may have liked. But it was a fairly seamless process, but clearly it starts off with the unit holders being prepared to accept that change.
Thanks. Bill, I don't know whether you wanted to add anything to that in seeing the way these structures have been changing over time.
Yeah, look, I think it's actually quite a big topic, Mick. With the LICs have obviously been plagued by these discounts to NAV, and it's been something of a holy grail to try to figure out ways to get rid of that discount to NAV. And the bottom line is it's actually quite easy to get rid of the discount to NAV if you're prepared to take your medicine. And the medicine is that you no longer have a locked up amount of FUM. So the only way you can really permanently get rid of the discount to NAV is to unlock it and allow there to be redemptions and or secondary trading / market making, which ultimately ties back to redemption. So unless you're prepared to take the risk to allow redemptions, it's very difficult to remove a discount to NAV just using technical solutions. But it has worked very well for those who have tried it. So, for example, in the market, you've got Fat Profits at the moment who, as soon as they announced that they were providing a liquidity mechanism by way of an in-specie buyback feeding through to an ETF, their discount to NAV almost totally disappeared as soon as they made the announcement, let alone actually executing. So it's quite clear that you can get rid of your discount to NAV if you're prepared to implement a structure. And there's a couple of ways of doing it. There's sort of some ways which are more complex, some which are a bit more simple. It just depends, sort of how tied up you are on delivering certain types of tax outcomes. But you don't have to have a big, massive scheme of arrangement like some people have done. You can just simply make it a voluntary in-specie ongoing buyback mechanism. So you can actually make it relatively straightforward. But I do think it is a very big topic.
Thanks, Bill. I agree with you. Maybe a final question for you, Russ. Bill and Rick both commented on sort of the time frames that could be expected. Have you got any view on what sort of time frame managers should think about if they're wanting to go down this route?
Look, I think Bill, really hit the nail on the head. I think you can expect around about 6 months Probably longer if your strategy is a bit more complex, but I don't think, Rick's experience of 12 months, I think we've seen the end of that, hopefully. But, I think in some cases, if it's a vanilla global equity strategy or an Australian equity strategy, I think you could probably do it under that 6 months. But I think, for planning purposes, I think it'd be safe to plan for 6 months.
Got it. All right. Thanks, Russ. Well, I might sort of stop there in the discussion with the panel and ask people if they want to ask any questions. They can use the Q&A chat function that's on the screen there. So we'll keep an eye on that. So happy to take any questions now, and perhaps as we're waiting for people to ask any questions that they happen to have, I might just sort of try and pull together the threads of that discussion. So I guess my own observation about this market is that for whatever reason, certain investors are much more happy to deal in the quoted and listed space because I guess all the advantages of immediate knowledge of pricing, immediate liquidity, for many keeping all of their investments in one spot with their own brokers platform that they utilise. And for a long period of time, the LIC market has served that well for, if you like, a collective funds management solution for particular investors. But the LIC market is very heavily focused in Australian equities originally. I think what we're seeing now is that, the development of these new vehicles means that those investors that have a preference for dealing in the listed space can now start accessing high quality fund managers. Well, they were accessing quality managers before. I'm not suggesting they weren't, but a more diverse spread of managers, and certainly across a more diverse spread of asset classes. And with the dual registry solution of a quoted fund managers can put a vehicle out basically that means they don't have to replicate more pools of investments, which is always something investment managers try to avoid. They can utilize an existing structure and effectively open themselves up to a much wider distribution market by getting to direct investors, and particularly if those direct investors, those that, in the self-managed super fund area, basically, that haven't had access to the diversity of investment strategies that they often would have liked to have had, because some of them are just so resistant to using the more traditional managed investment scheme that's unquoted. So, really appreciate your insights, Rick and Bill and Russ as well, because you've all been leaders in this space over the course of the last number of years. And I think it's a space that, will continue to develop and evolve. So, look, I've talked for a minute or so there waiting for questions, and I think I'm looking at the right spot to see them, but I can't see any coming through at the moment. So that must mean that you're all perfectly clear in your observations and sharing your experience. So perhaps just before I close, then I'll just say, Rick, whether there's anything else you'd like to add about your experiences and that might be useful background for the audience, and then I'll ask the same as Bill.
Yeah, maybe I'll make two observations which are not immediately obvious. Well, the third observation is that what I thought we could deliver, we actually delivered, and that is a good thing. So what I expected turned out to be. The two things which are kind of interesting are that, and I put it under the heading education, right? Because the marketplace expects listed vehicles to look like this or look like that. So we had a very large number of inquiries around what it is this was, and it meant that we had to staff that issue. We had to make sure that we could respond and deal with questions that were asked about exactly how this thing operated, even though it was written clearly in the PDS, written up clearly in the website. People still say, what does a market maker do? Do you need more market makers? Well, you don't if there's an internal market maker. Will there be a different price between unlisted and listed? Is it fungible between the two? So I would say you need to be careful about how you provide the right information to investors ahead of time to head off those kinds of queries. The second thing is, and I kind of knew this before we headed out, is that you end up with very spare information about your investors. Now, they invest with you, but all you know is their name and address. You don't know whether they're advised, you don't know anything about them. And that becomes a very important matter, because if you're trying to provide the right feedback to these investors, you don't even have an email address, right? So there will be, I'm sure, some mechanism through time that deals with this. But right now, there is a real problem in being able to connect with your investors and understanding who their advisors are if they are advised.
Yeah, thanks, Rick. I think that's a key point. Many of the LICs that have been in business for a long time spend all sorts of energy on the communication to their investors. As you say, sometimes they're anonymous coming into you, basically. Yeah. So, Bill, is any final thoughts you want to share with us?
Look, probably the one thing we've been a bit light on in the seminar so far is just, why do people do this? And when my clients come to me and they want to do it, it's really just about adding an additional distribution conduit to what's going on. So Rick mentioned earlier that the fund resulting from this endeavour on his part has, now represents 20% of his business. I think that's a pretty reasonable sort of outcome. So, and it sort of goes across the board that it seems to be that our clients do seem to pick up an extra 20% or so from a distribution perspective, just simply by being in that exchange traded space. So if everyone's wondering, why are you prepared to pay all these costs and incur all this effort, that's the answer.
Thanks, Bill. Russ, I've given Rick and Bill an opportunity to say any final words. Any you want to add?
Oh, look, it's a very important and growing aspect of the market, Mick. We're getting a number of inquiries, so I think this webinar was very timely, and hopefully it's been very useful for all the participants. But we expect this to continue to grow, and we're quite excited to be a part of it. And we look forward to establishing many more in the future.
Yeah, great. All right, thanks, Russ. I did get one question as we were talking there. So just if there's any good reading material on these subjects that are available, certainly people can contact us at Equity Trustees and we can provide you with further information. And we'll put this presentation up. Can be accessed if you'd like to get a copy of it. The ASX has some very good material around the whole exchange traded market and the options that are available, and of course your relationship managers, if you have one at Equity Trustees, or if you want to contact us if you're just starting off on this journey, please feel free to do that, and we talk to you about the journey and the process that you'd go through. So with that, I'd just like to thank each of our speakers. Thanks very much, Rick. Thanks very much, Bill. And thank you, Russ, for sharing those observations. This is, I guess, the leading edge to some extent of the funds management market at the moment. And I think, you're all experts in this area and can help clients. Well, obviously, Bill and Russ help clients in establishing this area, and Rick, for you, trailblazing the way with all your experience, and great to see the success that it's having for you. So we'll finish it there, and I hope everyone enjoys their Tuesday. Thank you very much.